How can we use Warren Buffett's investing style to find companies that are paying good dividends? I'll explain step by step how I used Warren Buffett's investment style to find a good company that I ended up investing in. Stick around to the end and I'll show you what company I ended up buying. The key features of Warren Buffett's investment style can be summed up in my two favorite quotes. My favorite holding period is forever, and the stock market is a device for transferring funds from the impatient to the patient. Warren Buffett likes to buy good companies when they're cheap and hold on to them forever. Disclaimer, this is not financial advice, this is for entertainment purposes only. I did a deep dive on Warren Buffett's investment style and came up with the following checklist. The 7 criteria for finding a good company are: it must have a simple business model, it must have a moat, consider Apple's iPhone, that's a unique competitive advantage, a low debt level, it must make enough cash to pay the interest on the debt level. They must have a predictable cash flow. The price to earnings, or the price of each share, must be relatively cheap. And most interesting to me, it must return a consistent dividend. So why would I choose companies that pay good dividends? Well, like Warren Buffett, I want to buy and hold for the long term. And if a company pays consistent dividends, it means that I can generate an income from just holding those shares. I have an older friend who's an excellent example of why investing in dividends is a good idea. He was a low-level tradesman in a company, invested what little spare cash he had consistently over the years, and now he's retired, he's able to live off those dividends alone. His investment style was similar to Warren Buffett's in 2 ways. He bought into a company that paid a consistent dividend, and he never sold a share. Now we get to where the rubber meets the road. How do I convert Warren Buffett's checklist into something usable so I can actually find companies? I use a stock filter. With a stock filter, I can sift through every single company on the stock exchange and get only those companies that return a dividend and are making a profit. I want companies that are mid-size or larger, return a profit, and their dividend is 10% or more. When we narrow Warren Buffett's checklist down like that, it's actually quite simple. I promise I'll show you soon what makes my method simpler than Warren Buffett's. But first, I'd like to dive a little bit deeper into those metrics, but I promise you it's not hard. Don't stress about writing any of this down. I'll put details in the description below, but if you have any specific questions, leave a comment and I'll try and get back to you. Dividend yield is the key metric I'm interested in. It will let me know what the company returned last financial year. How to make sense of dividend yield? Well, if I invest $1,000 and the dividend yield is 10%, that means I get $100 a year. To make sure companies are also returning a profit, I want a positive profit margin, operating margin, and quarterly earnings growth. If you want more details on any of these metrics, leave a comment below and let me know which ones, and I can make a follow-up video. Using the filter I created, I now have a small list of companies that I can examine in detail. Looking into each company, I can then rank them against Warren Buffett's checklist. I'll show you how I do this by using a real company on the list called Yancoal. Simple business model. This is easy. Go down to the description of the company and see if you understand what the company does. Yancoal explores, produces, and develops coal for the steel and energy industry. I understand the idea of coal in the production of steel and energy, but I don't know all the variables that go into making a profit from the industry, so this is a negative for me. For moat, Australia alone is teeming with mining companies producing coal, so Yancoal does not have a moat. Debt to equity. Looking at stockholders' equity and comparing that against total liabilities, we can see that the graph does not look great. It is only in the last 2 years that the graph has started to look good. Debt to equity is going to get a negative from me. Interest coverage ratio. Looking at the earnings and the interest, we can see that earnings has only covered the interest in the last 4 years. So for interest coverage ratio, I'm going to put a negative. Low debt levels. Looking at this chart, we can see that total assets has remained greater than total liabilities for quite a few years, so I'm going to mark this as a positive. For predictable cash flow, let's look at net income, total revenue, and total cash from operating activities. It looks okay recently, but in the past there have been long periods of losses, so that gets a negative from me. Now for price to earnings, this is fairly easy. We can look at the bar chart for price to earnings. It shows Yancoal against the industry, the sector, and the market as a whole. So that's a positive from me. Because we have a small list of companies, it's not hard to go through each of them and answer Warren Buffett's checklist. And here's where I explain how I've adjusted Warren Buffett's checklist to make it simpler so that it works for me. Warren Buffett would not touch a company that didn't have a simple business model that he could understand and that didn't have a moat. In my opinion, no company has a simple business model and no company has a moat. And this is where my method has to differ from Warren Buffett's method. He famously didn't invest in some of the biggest tech companies because he didn't understand the business model. He also loves investing in companies that have a moat, like Coca-Cola. My checklist removes those two things, a simple business model and a moat. You might ask, who do you think you are removing two items from Warren Buffett's checklist? He's the greatest of all time. I'll answer that by saying I have to, otherwise I'll never invest in any company. What does it mean to understand a business anyway? I understand the tech sector, being a computer programmer, but if you ask me if I truly understand the business model of one of the tech companies, I'll have to say no. And as for moat, in the tech sector, there are a few companies I know that have a moat, like Apple has its iPhone, Google has its search engine, but even Apple is competing against Android, and Google's now got ChatGPT to contend with, so do they still have a moat? What company did I end up buying? New Hope. For me, it ticked the most boxes. It had a good debt to equity ratio, good interest coverage ratio, a stable and predictable cash flow, and decent dividends. Plus, the stock price was reasonable. I've now bought some shares, so let's see how it performs over time. I'll leave you with that for now. Check back for more videos about stock investing.